Hi, I'm Asit Bhandarkar. I'm a fund manager with JM Financial Mutual Fund for I think almost 17 years now. Overall, I have been in equities for almost 22 years now. It's been a rewarding, fruitful journey. I always wanted to be fund manager, a person who deals with equities, a research analyst at core. I grew up in very exciting time. India fundamentally changed in 1991 when we liberalized, and it really opened up tons of opportunities for Indian businesses. Ended up being a watershed moment for the businesses, for the country. And to that extent, I guess it tickled my interest as far as analyzing these businesses are concerned and kind of wealth that can be created in a free market economy. In that sense, very lucky because validated the thought process over last 22 years has been quite rewarding. I would sort of think that I started my career, ScanX was around 3,000 and we all know where ScanX is today. So it's been a wonderful and rewarding journey personally on a career front. I'm not built to do monotonous, boring jobs. That's not my personality. To some extent, I would think that this is a business which is very dynamic. Things keep changing here. Every quarter results come. Government policies change, the environment changes. Now we are part of integrated global market, and to that extent, the dynamism that this brings and the excitement that it brings really attracted me to the field of equity research. And of course, I can't deny the fact that kind of wealth generation that is possible, by following companies and their fundamentals, and that sort of attracted me in a big way. See, our aggressive hybrid fund is a category where we have minimum 65% in equity at any point of time. So the rest, the assets are actually to be invested on the debt side. So this is a hybrid kind of investment strategy. Minimum 65% in equity, maximum 80% in equity. And from the debt side, it would be minimum 20% in debt at any point of time and maximum 35% in debt. What we've seen is that this sort of gives a very good balance to an investor's portfolio because your allocation needs of debt and equity are combined together in this fund. And in that sense, it makes the asset allocation of the investor more complete through a single fund allocation versus putting money in multiple funds. I think specifically for our fund, I think what will sort of, help the investors is to understand what our strategy is, because see, all the funds in this category are of course aggressive hybrid funds. They have the same mandate of managing between 65 and 80% equity and the rest of the money in the debt side. The investment process that we follow in the fund house as a whole, what we call the geek philosophy, where our focus is primarily on growth of earnings of stocks. And so typically what would happen is we would pick sectors where the growth of earnings is very high to be overweight on, and then we would pick stocks within them which sort of are growth leaders. But we are very quality conscious and we try and avoid all the mistakes that can come through during a growth phase of a company. Although in large cap companies, typically, chances of mishaps are less, but still we watch out for quality in the names that we buy. We try and make sure that the return ratios of the companies that we buy are reasonably high. We typically prefer ROEs of about 15%. We ensure that the debt equity of the companies that we buy is very comfortable, maybe less than one, or probably no debt also. And we also look at the cash flows that the company generates. We are reasonably averse to companies which do not generate cash flows. Markets are now at a very interesting stage. We had an excellent run in the markets over the last 1 year, driven by strong corporate performance, but also driven by very strong flows. As things stand, we are seeing that as geopolitics is playing out globally, FIIs seem to be exiting Indian market. And to that extent, I think it's less to do with the opportunities available in India for them, but it's more to do with the opportunities available ex of India. India, to some extent, looks a little expensive relative to the rest of the world. And we believe that after this adjustment phase is through and there is a little bit of a time correction that we'll see, our market should do quite well. Meanwhile, I think we are seeing very strong domestic flows. There is a strong floor and support to this market. And we would say that, this is a great time to allocate money to the market, because last few years, it has been a one-way upward move in the markets. An investor has not really got an opportunity to put good capital to use at a fair valuation, because every month the market would just keep going up. I guess we're in a phase of volatility right now, but I would urge the investors to look at this as an opportunity, because this is a point where you can allocate capital over a period of time. And if somebody has a view of 2 to 3 years, it will be probably a reasonable period for an investor to make reasonable returns from here. Well, that's quite dynamic. I think in India, typically sectors associated with consumption will do well. What we are also seeing, as there are uncertainties with the global trade and the geopolitics globally, we would think that companies which are domestically focused and companies where they are benefiting out of the manufacturing renaissance in this country will do quite well. So as we look at the opportunities, we do see manufacturing revival as a good story to play over the next few years. We also see that consumption, which has been sort of depressed in this country, will sort of start reviving on back of a good monsoon this year and perhaps even next year. So the rural economy should also start doing very well, and the sectors which are associated with that should also start doing quite well. What we do typically is that we are very conscious about two things. When markets are going good, we try and make sure that our equity allocation is on the higher side. So basically, instead of say 65%, we'll be more closer to a 80. That maximizes the returns for our investors when equity markets are doing very well. On the other hand, when we are looking at, say volatile markets, difficult markets, where, probability of equities generating negative returns becomes a little higher, we shift the allocation more towards our lower benchmark, which is 65 to 70%. And to that extent, what happens is that in a market where the probably, index gives negative returns, where the benchmark gives negative returns, in the equity category, this would be the fund which falls the least because of the allocation to debt. And we use this flexibility quite aggressively. On the equity portion itself, I think what distinguishes us is that we are growth focused, and that has sort of helped us over the last decade, because our focus on high growth, high quality stocks has ensured superior alpha generation for our investors. And I think that is that's sort of the philosophy of the fund house itself, where we buy high growth stocks with a reasonable quality filter. I think what I would also tell our investors here is that, see, our equity portion is not cap biased. Here, because there is a big cushion of, the debt portion of the fund, which protects the fund in volatility, we take quite aggressive calls on the equity side, and we are cap agnostic. I mean, we could have this portfolio substantially tilted towards small caps like we had last year. In difficult times, we can move the equity portion substantially towards large caps, as we had it during COVID period. Specifically for investors, I think what I would like to highlight is that we manage the equity and the debt allocation quite aggressively. What we try and do is that during equity market conditions, we ensure a higher allocation towards equity. So this fund would typically be invested almost 75 to 80% in equity on such occasions. And when we see lack of clarity, volatility, or maybe possibility of negative returns in the market, we tilt the portfolio more towards debt, with the equity portion going down between 65 and 70%. Second thing I would like to, highlight here is that on the equity side particularly, we follow our fund house philosophy of buying high growth stocks with a reasonable quality filter. That has sort of helped us quite well over the last few years, because our ability to pick high growth stocks in an economy like India has really been a big differentiator in creating alpha generation, in having alpha generation for our investors. So I think that is the thing that I would sort of say. And what also I would say is that this fund is one way where an investor doesn't have to buy, two separate funds to allocate money into debt and equity. We sort of put it together. So in that sense, what happens is that you get a less volatile exposure to the equity market, because the debt component sort of reduces. Overall, over a 10-year cycle, what you would see is that the returns are reasonable, and alpha generation is also quite reasonable.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing.